because this was about Roth IRAs, I'd like to say that the Roth IRA is actually a great tool. And it's if you understand the rules and you understand how it works, you can actually use this for the Roth IRA for lots of other planning. And planning in general, it's really about understanding what the rules are, keeping up with the rules as they change, because unfortunately they do change. Taxes change, everything changes every year. But it's understanding all these things and putting it all together to come up with a good financial plan for the future.
Yeah, I like that. Can you give a couple of examples of other areas in financial planning you can use a Roth IRA?
I use it quite a bit in college education planning. And there's 529s and there's big differences between the two, but I use it for Roth IRAs for that. I'll also use the Roth IRAs in terms of legacy planning.
Hi, my name is Annette, your host of the Wealth Inside and Out podcast. I'm a certified financial planner and founder of the Millionaire Insider. For over 30 years, I have been advising and researching the top 1% of millionaires, and I am passionately obsessed with money, mindset, and the intersection of self-worth and net worth, and how the two connect and allow us to live fulfilled and wealthy lives on our terms. I'm a Midwestern girl who had a dream, began investing $25 a month 35 years ago, and today have a multi-million-dollar net worth. I teach the tried and true that only someone with over 3 decades of experience advising millionaires would know. This podcast is different, about much more than money. We talk about mindset, success, money blocks, worth barometer, and all aspects of money and topics from practical manifestation, along with real-world how-to and everything in between, with the goal of making your journey easier and more fun. Think of this as coffee, actually matcha tea, learning real-world common sense money and life advice from a BFF that you can start applying today. If you want to create a financially free life you love, you are in the right place, my friend. This is the Wealth Inside and Out podcast. So before we dive into today's call, I want to just make a note that this was recorded for 2023, and it's imperative that you check with a qualified advisor and or tax professional before changing anything in your financial plan. Tax laws are constantly changing, and that's why it's so important to check with a qualified advisor and or a tax expert before implementing any changes. If you need support, you can go to themillionaireinsider.com/support-request. But again, before you make any changes, it's imperative that you consult with a qualified advisor or a tax expert. For today's show notes, you can go to themillionaireinsider.com/9. For all shows, go to themillionaireinsider.com/podcast. So today's bonus resource is our retirement plan checklist. You can go to themillionaireinsider.com/RPC for retirement plan checklist. You're going to love this free resource because it provides you an overview of the actions you need to take to avoid worrying about running out of money. And it's going to help you to ensure you're going to live your life and retirement on your terms. We share insights in this free retirement planning checklist resource that many people don't even think about. So again, you can go to themillionaireinsider.com/RPC to access it. One of the biggest concerns women have is becoming a bag lady. This guide was specifically designed to provide you the first step to help you create a plan so you can stop worrying about running out of money. Again, themillionaireinsider.com/RPC. You're going to love this resource. So let's dive in. The information we provide is not intended to replace any investment, financial, tax, or any other advice. Before beginning, please consult with your own team of advisors and review your situation. You agree to hold MillionaireSeries.com, Annette, and all affiliates harmless for information contained in these trainings. All international copyrights are reserved. So I want to welcome Oscar Alvarez. He is one of my advisors studying to become a certified financial advisor. And so welcome, Oscar. It's great to have you on the call.
Thank you for having me on, Annette.
You're welcome. So I've known Oscar for quite a while, and he's a certified financial planner as well as a certified divorce financial analyst. And he founded his company over 28 years ago, and he has helped many women and other individuals going and facing a life transition, such as divorce, loss of a loved one, and also inheritance planning. He is a fiduciary, and he specializes in estate planning, retirement planning, wealth management, and tax planning, as well as comprehensive financial planning. And he served our country. He's just a great guy. So it's so nice to know you, Oscar, not only on a personal level, but also to know all the people's lives you're affecting. So again, I want to thank you so much for sharing your wisdom. And what we're talking about today are IRAs, specifically Roth IRAs. And it's something that I think a lot of people get confused on. So I just want to dive right in. Can you just start by explaining the difference between a Roth IRA and a regular IRA so people understand the difference?
Absolutely. Most people, when they hear IRAs, they think of traditional IRAs. And so the difference is, and I'll go through traditional first. The traditional IRA is an IRA where you're making a contribution into the IRA, but you're taking it off on your taxes. So it's a deduction on your taxes, on your 1040. And so it helps you pay a little less taxes today. The Roth IRA is significantly different in that you're taking money after you've paid taxes on it and you're contributing it to the Roth IRA. And so you don't get any deduction today. There's no tax advantage today. But what happens with the Roth IRA is the money inside is growing tax-free. The traditional IRA is growing tax-deferred. Two different terms, which have very significant different meanings. Tax-deferred means that you will pay taxes later, not today. Traditional IRA. Roth IRA, you're going to pay taxes on the money you put in today. You don't pay taxes on it later. And the even better thing is on the earnings, you pay no taxes on it later as well. So it's great.
Wow. Now, when do you take money out of a Roth? Meaning, is there a time period or an age?
There's a lot of rules to when you can take the money out. The basic rule is 59 and a half. You can take the money out of a Roth IRA without having to worry about taxes or penalties. The Roth IRA is a little bit unique in that if you start taking the money out before 59 and a half, we get into a whole bunch of different rules, and we'll go over some of those in a minute.
Okay. So does it benefit like certain people to have a Roth IRA as compared to an IRA, or how do you determine that?
So the Roth IRA is a great vehicle, but it's really geared for people who, one of two things, either they believe they're going to be in a higher tax bracket later in life or at retirement, or they believe taxes are going to be higher in the future and they'd rather pay the taxes on the money today as opposed to what they think it might be in the future. So that's the reason why most people will get into the Roth IRA.
Is there anyone that doesn't think taxes are going to be higher in the future?
No, I am a big believer. If I could be a betting man, I would say they're going to go up. It's just a matter of how much and when. But with the debt we have, yes, they're going to go up eventually.
Yeah, it's kind of like, people are at this party and it's like the elephant in the room. No one's talking about it, but it's like, okay, at some point we cannot get away with a free lunch. And I think a lot of people are hoping, it's almost like they're hoping during their life, but somebody's going to have to pay ultimately. So yeah, that's good. So I know you touched on some of the benefits, but let's just dive into some of the benefits of the Roth so that our listeners can get clear on it.
So, I said a couple of things that the tax-free, making it tax-free forever is great. Keep in mind, you're also not going to get it like on a normal brokerage account, you get a 1099 every year. You're not going to get one of those every year. So that's great. I love that. The other thing with a traditional IRA, at age 73, and it just changed to age 73 now, the required minimum distributions are mandatory. You have to take out money at age 73. With a Roth IRA, there is no required minimum distribution. So you can leave it in there forever. I have a lot of clients who basically they're going to leave that as inheritance to the kids. Mm-hmm. And the great thing about it being an inheritance is when they inherit that money, it continues to be tax-free. Lots of rules about inherited Roth IRAs and traditional IRAs, but they're essentially going to get this money tax-free. Those are really the big benefits.
Do they ever have to take it out when they inherit it?
Yes, they do. There is a required minimum distribution for inherited IRAs, including the Roth IRA. And basically, though, if you think about people who are going to inherit it, they're probably in their 40s, 50s, maybe 60s. So the requirement distribution is based on age. So they're going to have a small amount that they'll have to take out. My wife inherited a Roth IRA from her mom, and we're talking just a few $100s a year is what she has to take out. So it's very minimal, unless it's, once again, it depends on how large the Roth IRA is, but it's all tax free.
And is that at a certain age?
As soon as they receive the Roth IRA, they have to start taking RMDs. Now, one of the rules that just came out a couple of years ago is they have 10 years that they have to take the money out. So if my wife were to inherit a Roth IRA this year, she has to take the required minimum distributions for the next 10 years, but in the 10th year, all the money has to come out.
So that's for both rule. Traditional and Roth?
That's any inherited IRA, traditional or Roth IRA, it has to come out in 10 years. And so it requires some planning in advance to make sure it's done correctly.
Okay, gotcha. So let's talk for 1 minute about like the qualifying income. Like, is there a certain amount of income that allows you to qualify to put money in a Roth? And how does all that work?
So qualifying income is important. So when we say qualifying income, that means you have to have W-2 income in order to contribute to a Roth IRA or even a traditional IRA. You have to have W-2 income. Now, having said that, there are parameters about how much income you can have or not have to make that contribution, because the IRS sets limits. So, for instance, somebody who's single or head of household, if they have $138,000 or less of income, they can contribute to the Roth IRA. However, between $138,000 and $153,000, it's tiered, so it reduces how much they can put in.
Okay.
And so at $153,000, they can no longer make any contributions to the Roth IRA. For somebody who's filing joint, they can do $218,000 or less. They can put in the full amount. Between $218,000 and $238,000, it's tiered again, and at $238,000, they can't put any more in. So those are the income parameters. Now, how much you can contribute every year, for 2023, you can put $6,500 per person into the Roth IRA. If you're over 50, you can do $7,500 per year per person into the Roth IRA.
Okay, great. And so just so I'm clear on that. So if you're filing joint, married filing joint, and you make less than $218,000, or you make $218,000, you can do the full either $6,500 or if over 50, $7,500 per person.
Right. Per person.
Okay, awesome. So are there limitations on what a person can invest in as far as in a Roth IRA?
Actually, there is. It's a funny question you ask. Lots of people ask me, well, how much does a Roth IRA work? And what you have to try to keep in mind is a Roth IRA, you got to think about it as an envelope. It's just an envelope. Now, what you put in the envelope is up to you. So in a Roth IRA, it can be cash at the bank. It can be a CD at the bank. It could be mutual funds. It could be electronically traded funds, ETFs. It could be gold and silver. It could be real estate. It can be quite a few things. Probably the two big things that it cannot be is a life insurance policy or derivative investments. But pretty much it's a pretty open field with what you can use, what you can put inside that envelope called a Roth IRA. So just look at it that way.
And then like if you're going to put real estate in it, then do you have to have a special custodian?
Yes. If you're doing with like gold, silver, maybe commodities, things like that, you would have to have a special custodian setting that up. And there's special rules for all of those. You just have to understand what the rules are, and you got to do some homework. Real estate's a real tricky one as well, because you got to be careful about, in a Roth IRA, you don't have to worry about it, but moving it to somebody else becomes an issue later in life when somebody inherits it.
Can you just explain to our listeners, what is a custodian?
A custodian is a company that are experts and work with dealing with IRAs or Roth IRAs in certain types of commodities like gold or silver or real estate. These people are experts and that's all they do. Unlike, somebody like me, I'm handling mutual funds and ETFs. But if somebody says they want to put an IRA in real estate, I'm not the person for that. So you want to go to somebody who specializes in something like that. Well,
and it's just a matter of finding a custodian that will allow it, right? Because that's kind of like a self-directed IRA as compared to a directed.
Correct.
Okay. All right. So now if a person, getting back to what you were talking about, where you have to have W-2 income. So what happens if a person doesn't have any W-2 income?
The first rule is if you don't have W-2 income, you can't contribute to the Roth IRA. However, if you're filing a joint tax return, and I'll give an example again. So if my wife has no W-2 income and I do, I can make a contribution on her behalf. Now, the key there is, so if I could put 7,500, because unfortunately I'm over 50, so I could put in 7,500 for me, and I could put in 7,500 for her. I just told you what her age was, right?
Mm-hmm,
and so, but I have to make sure that I have the $15,000 of earned income. If I only had $10,000 of earned income, I could do 5,000 and 5,000. So,
or 7,500 and 2,500.
Right.
Perfect. Okay. So you know, we talked a little bit about withdrawals, that they're tax free, but let's walk through that. I mean, just to make sure our listeners really understand that.
The general rule, and what most people look at is when you have a Roth IRA after 59 and a half, you can take all what you put in and the earnings tax free. It's before 59 and a half that it gets tricky and people get in trouble with this. So the first rule that you have to keep in mind is that any money you put into a Roth IRA, you can take out at any time. And so if I put in $5,000 this year and next year something comes up, I can pull out my $5,000, no taxes, no penalty. The trick is that people have earnings. So if I've had it there 2, 3, 4, 5 years, and over, let's say the course of 5 years, I put in $20,000 and it's grown to $25,000. If I pull out the whole $25,000, I'm going to pay taxes on the $5,000, the earnings, and I'm also going to have a 10% IRS penalty on top of that because I was not 59 and a half at the time I took it. So those are probably the two big things people get confused with. But there are some caveats, and this is where it gets tricky.
Let me clear one thing, just so I'm clear. So with the scenario you gave, the tax and the penalty is only on the earnings, not
Correct.
on. Okay, gotcha. All right, go ahead.
Correct, just on the earnings.
Mm-hmm.
And so the caveats get confusing, and this is where a lot of people get in trouble. So first of all, you can take out before 59 and a half, you can take out all the money if you're using it for higher education or if you're disabled. No taxes, no penalty. You can withdraw the entire amount.
Okay.
Now, the other caveat is if you want to purchase a home. So you can take $10,000 out of the Roth IRA, no taxes, no penalty. $10,000 per lifetime. So that means I could do it one time in my life, and I can buy a house for myself, my children, my grandchildren, or my parents. But it's a one-time thing. The other caveat is if somebody's adopting, they can take out $5,000 for the purpose of getting an adoption.
And what about medical expenses?
Oh, medical also. If you have unreimbursed medical expenses, you can take the money out as well. The thing you need to be careful is you want to make sure you get good receipts because you're going to have to show that on your tax return, those unreimbursed medical expenses.
And that's $5,000 for medical expenses as well as adoption?
No, it's two separate. It's $5,000 just for adoption. Medical expenses, you can take out as much as the medical expenses are.
Oh, so medical expenses are unlimited and adoption's $5,000. And
Yes.
that's adoption per child. And then
Correct.
if you have, say, for instance, $10,000 of medical expenses, assuming you have enough in your Roth IRA this year, and then another $10,000 next year, you can do it. Or if you adopt another child, you could do $5,000 per child. Okay, that's great. So what do you recommend people do if they don't qualify like for a Roth because of their income? Because I mean, some of us don't qualify and, you know, it's so attractive to be able to have a Roth. Is there anything a person can do if they don't qualify? They're making too much income other than not make as much income?
Well, and I have a few clients that have too much income to qualify under the normal parameters.
Yeah.
But there's this little IRS loophole that has been labeled the backdoor Roth IRA. And essentially what you're doing with what we call the backdoor Roth IRA is you're taking money and you're putting it initially into a traditional IRA. Now, here's what's important. This is money because you obviously don't qualify to put this money in, but you're going to put it in anyway. And you have to file an IRS form 8606 showing that you made this contribution because it will not be deductible on your taxes. But you let the IRS know that you've done this. And so You put this money into a traditional IRA, you can't deduct it, so you get no tax benefit today. And then a week later, a month later, it's up to you. You can then convert that money and take it from the traditional IRA and put it into a Roth IRA. We call this a Roth conversion. Now, what you have to make sure of, and you got to be careful, is when you put the money into traditional IRA, you just want to leave it in cash because you don't want it to earn any money until you move it over. So there's no tax issue. So if you put in, for my case, if I put in 7,500 and I convert 7,500, there's no tax issue because I haven't made any money. And that's how you want to do it. So it's just really up to you how quickly you want to do it. And then you can invest it in all the different things I mentioned earlier. So you want to be careful with that. The nice thing about that is when you do that, you're basically taking money that would have been taxed and you're making it tax-free. It's a slow process because you're still limited to the 6,500 or 7,500, depending on your age, in terms of contributions. So you can't do a whole bunch at one time. Now, having said all that, the new rules allow somebody to take as much as they want from a traditional IRA and convert it to a Roth IRA. Now, it's a great thing. And so there's lots of people doing that, but you have to be careful. This is where I do recommend people get with their CPAs or tax accountants to make sure they do this right. But for example, if I'm going to convert $10,000 of my traditional IRA to my Roth, it's like I'm earning another $10,000. And so I got to pay taxes on that.
Yeah.
So when people do this, you just want to double check with your tax person to make sure you're not putting yourself in a new tax bracket or it's not significantly hurting you on your taxes. So you just have to plan this out and think it through. But it is a great time right now to do that because I can tell you what's going to happen in 3 years. Taxes are going up. The tax rules are unfortunately going to revert back to the old rules in 2025.
Yeah. So just so I'm clear, so as far as converting a traditional IRA to a Roth IRA, I mean, is there any limit as far as income on that or?
No, anybody can do it. Doesn't matter how much there's no limits on income or amounts or anything. There's no restrictions.
That's great. And then my next question is, as far as taking that backdoor Roth IRA, are there any income limits on funding an IRA or any amounts?
So you can fund your IRA only to the limit per year. For instance, I can put my 7,500 into a traditional IRA and convert it, but I can't also put a 7,500 into a Roth IRA. It's just one or the other, and it's whatever the limit is, 65 or 7,500.
Oh, so that's a total, like between an IRA and a Roth, you've got either the 6,500 a year or the 7,500, regardless of incomes.
Correct.
Okay. All right. That's good to know. So why would a person convert, other than the back door, why else would a person convert a traditional IRA to a Roth?
It goes back to the reasons I gave right at the beginning. If somebody thinks that they're going to be in a higher tax bracket later on, or they think taxes are going up, that's the reason so many people are converting their traditional IRAs right now, because they believe, like you and I do, Annette, taxes are going up.
Like, if you don't believe taxes are going up, I mean, I don't know. I don't want to say you're like get evaluated, but I mean, I don't know how they can't. Like, if somebody could make an argument for me, I know politicians want to get elected, but at some point you just can't keep ignoring it, right? I mean, at some point we got to acknowledge that.
That's a whole nother discussion, Annette.
Yeah. And it's, I'm sure, one that can really trigger people, but could you just give us, like, walk us through some numbers? I mean, some of the people on here probably would say, okay, walk me through this so I can understand it. I don't know if I kind of putting you on the spot, but if you could give us some numbers.
Hopefully I can do this so everybody can follow this easily. I'll just give you an example. I've done this for so long and I see these things, and these numbers are probably reasonable for a lot of my clients. But let's first assume that taxes aren't going to go up. I don't believe that, but let's assume for this illustration that taxes are not going to go up in the future. So married couple, mortgage, couple of kids, gross income's $170,000 a year. Now, they're going to have lots of deductions. When they do their tax, they're going to have, I'm just going to assume that they've itemized, they've got the kids. And so what we call their modified adjusted gross income, which is what they actually get taxed on, and that's line 15 of the 1040. That's what they actually get taxed on. Let's just say the gross was 170, now it's 130. Their modified adjusted gross income is $130,000. So if I were to just look at the tax tables, the 170,000, their taxes would be 29,114. But because of itemized deductions and now they're at 130, it actually goes down to 19,214. So that's a big decrease in their taxes because of all the deductions, which is great. So I always tell people, what's your tax rate? And they always tell me their tax rate is the window that they're in, whatever category they're in. Now, these folks would be in the 22% tax bracket, but their net effective tax rate, what they actually pay in taxes in comparison to their gross income, their net effective tax rate is only 11%.
Wow.
And this is very common in a lot of families that I see. They're usually between 10 and 15% net effective tax rate, even though they might be in the 20. I got a client I'm working with now. I don't know how his tax guy's doing it, but he's at 10% and he makes over $500,000 a year. So he's got a lot of deductions.
Wow.
But so you have to be careful about what you're looking at. So now let's take it 20 years later. Okay, this couple, the house is paid off. The kids are gone. They're doing fine on their own. They don't need mom and dad's money, so they don't have to worry about that. But now this couple, they're retired. Between retirement and pensions and their investments, their modified adjusted gross income is about $100,000. So now the taxes that they're going to pay on that $100,000, keep in mind, they're in the same 22% tax bracket. That's what they were at 170. And even at 100, they're still in the same tax bracket. But now, because they don't have any more deductions, all they get is the standard deduction. So on their income, their taxes would be $12,614. Their net effective tax rate is 12.6%. So they went from $170,000 and a net effective tax rate of 11% to $100,000 and 12.6% net effective tax rate. A small increase, you say, well, it's only 1%. But remember at the beginning, I said, let's assume taxes don't go up.
Yeah.
Well, as I said earlier, in 2025, this couple would be in the 25% tax rate.
Wow. And it's actually 1.6. So it is almost 2%. But and then you take into account, that's huge. And see, this is why, my friends, if somebody are going, oh my God, that's so overwhelming. I don't want you to get overwhelmed. What I want you to realize is it's important to have somebody look at those numbers so that you can say, what does this mean? Because if you say to somebody, well, you're in, whether it's 11 or 12.6, you're like, okay, not a big deal. But when you go from 11 to 25%, that's 14%. That's huge. And that's bottom line money that you could have in your pocket. So if you say, okay, it's 14% and you're talking 100,000, I mean, that's $14,000. Now, all of a sudden you're going, okay, I could save, what can you do with $14,000? Well, there's a lot of things, whether it's, some remodels in the house, a nice trip. I mean, there's a variety of things, saving extra money for retirement. So those are the things you got to take into account. But that was a great example. I'm sure some people are going, oh my God, this is overwhelming. But is there anything else that people really should know? I mean, we've talked about the importance of like planning, and I want to just reiterate that, creating a plan so you're looking at your big picture. This is just one element of your big picture. But is there anything else that you want to leave the listeners with that they should know or do?
Well, yes. And because this was about Roth IRAs, I'd like to say that the Roth IRA is actually a great tool. And it's if you understand the rules and you understand how it works, you can actually use this for the Roth IRA for lots of other planning. And planning in general, it's really about understanding what the rules are, keeping up with the rules as they change, because unfortunately they do change. Taxes change, everything changes every year. But it's understanding all these things and putting it all together to come up with a good financial plan for the future. My goal is always, and I differ with CPAs, CPAs like to save taxes today. My goal is always to get my clients to pay the least amount of taxes for the rest of their life.
Yeah, I like that. Can you give a couple examples of other areas in financial planning you can use a Roth IRA?
I use it quite a bit in college education planning. And there's 529s and there's big differences between the two, but I use it for Roth IRAs for that. I'll also use the Roth IRAs in terms of legacy planning. So if people want to leave money, that's one of the ways they can do it. For instance, I'll give an example. I have clients that are converting traditional IRAs to Roth IRAs because they're in a lower tax bracket now than where their kids are, because their kids are doing well.
Yeah.
And so when the kids inherit the money, they're going to have less taxes to worry about.
Yeah, that's good. And you said education was the first one you talked about?
Yes.
In a 529 plan? Is that what you?
Well, so depending on the income of the parents, we kind of make a decision which is best, the 529 or the Roth IRA. Because here's the thing with the Roth IRA, when they fill out the FAFSA, the Roth IRA doesn't count. So even kids, if they're working and start a Roth IRA, that money's hidden. And guess what? Like I said, if you use it for higher ed, you can still pull it out. So it's a way to look poorer on paper for the FAFSA, but still have the availability of the money.
Yeah. And I still don't understand why they make everyone fill out the FAFSA. Because we have 2 kids in college and we have to fill it out. And it's such a nightmare. And it's like, if you're not going to qualify, then they should just say, check a box, don't qualify and be done with it versus, I have to be honest here. I don't fill it out. My husband does, but all I do is hear all the headache and I need this and I need that. And it's like, it's just interesting, but it's a lot. And one of the things I thought was really interesting. So my daughter's a little older, but when she was going through school, and we didn't do this, but you could basically not claim your child on the tax return, and then they could qualify for a lot of aid. Well, they have figured that one out.
Yes.
Now, unless you are emancipated, like you cannot just say you don't qualify because, they're not on your tax return. They have to be emancipated, which means you have severed all ties and it's official because obviously they've figured that out, right? People are saying, oh, I don't claim them. They're no longer my child. Now they need to qualify.
Yeah, they closed that loophole a while back.
Yeah. And that is a big loophole. So anyway, that's great. This has been such a wealth of information. And I hope to our listeners, this has been helpful because I get so many questions about, what is a Roth IRA versus an IRA? What can I deduct? What are the advantages? What are the disadvantages? What are the rules? And you have made it so easy and simple for a person to understand it. And the one thing I will say is that rules continue to change and evolve. And I'm sure we're going to have a ton more changes in the next several years. Is there anything else you want our listeners to leave with that would be helpful?
Probably the last thing I'd say is just, you want to get somebody who understands the rules and has been doing this for a while. I prefer certified financial planners. I've been one. Somebody who understands the rules, who deals with it on a regular basis. The rules is what make the game. And so you just want to talk to somebody who really understands it and can sit through and look at not just today, but moving forward, what is it going to look like?
Yeah, I think that's great advice. And I think especially there's so many moving parts. And the one thing I think we can guarantee is that the rules will continue to change. And yes. I think just being on top of it and having somebody that is on top of it is really helpful. So thank you so much. This was such a wealth of information. And I'm so happy to be a part of your journey and just seeing where you've come from really impacting so many people's lives, women, couples, the whole gamut. So anyway, this was awesome. So thank you so much, Oscar.
Well, thank you, Annette, and have a great day.
So now for some of you that want more information, possibly you want to even reach Oscar, you have questions, you can go to themillionaireinsider.com/Oscar-Alvarez. That's OSCAR-ALVAREZ, Oscar-Alvarez. Or you can go to themillionaireinsider.com/support-request and access and share where you need help, where you need additional resources, and we can help you. Congratulations on taking another step to create a financially free life you love. If you're not sure about your financial future or that it's in order, or you are ready to stop worrying about money or possibly the fear of becoming a bag lady, ending up broke in retirement, or you simply are ready to know your financial house is in order so you can have a bright financial future, please go to themillionaireinsider.com/NSF. And that doesn't stand for non-sufficient funds. It stands for Next Step Finance. It's the next best step of what you need to do so you can avoid an NSF notice in your future. Again, themillionaireinsider.com/NSF. The number of women who were not broke or poor while working or married is staggering. The entire mission of the Wealth Inside and Out podcast is to ensure you have the information for you, your family, your friends, anyone who's willing to listen to it and apply it so that you can create a financially free life you love. Again, themillionaireinsider.com/NSF. Until our next episode, take one action that will help you create a financially free life you love. I'm Annette, your host. All international copyrights are reserved. Bye for now.